The electronic chime echoed through trading floors at 3:47 a.m. Eastern Time on January 23rd. Gold had crossed $2,500 per ounce for the first time in human history. No press conferences marked the moment. No government officials issued statements. The milestone arrived in the darkness before dawn, witnessed only by algorithmic trading systems and a handful of overnight precious metals dealers who understood they were watching the end of one economic era and the beginning of another. Within 90 seconds, silver futures spiked $4.30 per ounce. The correlation was immediate and unmistakable. For months, silver had been trading at a historic discount to gold, with the gold-to-silver ratio reaching levels not seen since the Great Depression. At 71, silver was cheaper relative to gold than it had been in 8 decades. The gold breakout was about to trigger the most violent silver catch-up rally in modern commodity market history. The precious metals explosion was 3 months in the making, though most market participants had missed the early warning signals. Institutional silver demand had been accelerating systematically since October 2025, when major pension funds began establishing physical precious metals allocations for the first time. CalPERS allocated $12 billion to precious metals. The Teacher Retirement System of Texas followed with $8 billion. Norwegian Sovereign Wealth Fund increased holdings to 4% of total assets. Corporate treasury departments were establishing precious metals positions as operational hedges. Apple had allocated $15 billion to physical precious metals storage. Microsoft established silver stockpiles worth $8 billion to hedge against semiconductor supply chain disruption. The shift from financial assets to physical commodities reflected systematic loss of confidence in institutional reliability. But this wasn't just about precious metals pricing dynamics. The gold surge was the visible symptom of invisible structural breakdowns that were reshaping global finance. Central banks had been accumulating gold at the fastest pace since the collapse of Bretton Woods. China purchased 180 tons in 2025. Russia added 150 tons despite sanctions. Even traditional dollar allies like Germany and France were quietly diversifying their reserves away from treasury securities toward physical precious metals. The technical analysis told a story of systematic dollar rejection that extended far beyond sovereign reserve management. 3 separate currency crises in emerging markets during 2025 had demonstrated that dollar liquidity could disappear without warning when geopolitical tensions escalated. Countries that had spent decades building dollar reserves were discovering that those reserves could be frozen or weaponized by American financial authorities whenever political circumstances required convenient leverage. American policymakers had created the conditions for gold's historic rally through a series of decisions that prioritized short-term political gains over long-term monetary stability. The weaponization of the banking system against political opponents, demonstrated through the Trump J.P. Morgan lawsuit, had convinced institutional investors that financial assets were subject to political risk regardless of legal protections or contractual guarantees. When banks could terminate client relationships for political reasons, when payment systems could be disrupted by executive orders, the entire premise of financial system neutrality collapsed. The technical analysis told a story of systematic dollar rejection that extended far beyond sovereign reserve management. 3 separate currency crises in emerging markets during 2025 had demonstrated that dollar liquidity could disappear without warning when geopolitical tensions escalated. Countries that had spent decades building dollar reserves were discovering that those reserves could be frozen or weaponized by American financial authorities whenever political circumstances required convenient leverage. American policymakers had created the conditions for gold's historic rally through a series of decisions that prioritized short-term political gains over long-term monetary stability. The weaponization of the banking system against political opponents, demonstrated through the Trump J.P. Morgan lawsuit, had convinced institutional investors that financial assets were subject to political risk regardless of legal protections or contractual guarantees. When banks could terminate client relationships for political reasons, when payment systems could be disrupted by executive orders, when even former presidents faced banking discrimination, the entire premise of financial system neutrality collapsed. The precious metal surge was accelerating exactly as trade relationships fragmented along geopolitical lines. Canada's recent decision to reduce tariffs on Chinese electric vehicles wasn't an isolated trade adjustment. It was evidence of systematic realignment that was undermining dollar-based trade settlement. When major trading partners chose bilateral currency arrangements over dollar intermediation, when commodity transactions increasingly bypassed American financial infrastructure, the demand for dollar-denominated assets declined while demand for monetary alternatives increased. Investment advisors were recommending precious metals allocations to clients who had never previously considered commodity exposure. The traditional portfolio construction models that allocated 60% to stocks and 40% to bonds were proving inadequate for an environment where both asset classes faced systematic political and monetary risks. Financial planners were suggesting 10-20% allocations to precious metals as insurance against scenarios that had been considered impossible just months earlier. Silver's industrial applications were amplifying the monetary demand through technological requirements that couldn't be substituted or postponed. Every electric vehicle required 1.3 ounces of silver for battery management and electrical systems. Every solar panel consumed 0.67 ounces for photovoltaic cells and electrical contacts. Every smartphone contained 0.35 grams in its circuitry. The technological revolution that governments were promoting through climate policies and digitization initiatives was creating industrial silver demand that exceeded annual mine production by an increasing margin. The mathematics of industrial silver consumption were becoming unsustainable. Global automobile production totaled 95 million vehicles annually. Electric vehicle penetration projected to reach 60% by 2030 meant 57 million EVs requiring 74.1 million ounces of silver annually. Solar panel installations consumed 140 million ounces annually, but targets required 300 million ounces by 2028. Electronics production, 5G infrastructure, and medical devices added another 90 million ounces to annual consumption. Smartphone manufacturing alone required 50 million ounces yearly as device complexity increased. Data centers supporting cloud computing and artificial intelligence demanded silver-intensive server hardware. Medical equipment manufacturing consumed 15 million ounces for antimicrobial applications that couldn't be substituted with alternative materials. Total industrial demand was approaching 600 million ounces annually, while global mine production remained stable at 800 million ounces. The supply deficit was masked by above-ground stockpiles that were being depleted faster than replacement production could be developed. Silver recycling provided 180 million ounces annually, but recycling rates were declining as industrial applications incorporated silver into products with extended lifespans. Mining industry executives were privately acknowledging that current silver production capacity couldn't meet projected demand increases. Major silver deposits required 7 to 12 years for exploration, permitting, and development. Environmental regulations and community opposition were complicating mining expansion in every major silver-producing region. Labor shortages and equipment costs were further constraining production growth even when regulatory approval could be obtained. Mining companies were struggling to increase production despite higher prices because of infrastructure constraints that reflected decades of underinvestment in extraction capacity. The world's largest silver deposits were concentrated in politically unstable regions where operational security required constant negotiation with local authorities, criminal organizations, and indigenous communities. Mexico produced 190 million ounces annually, but mining operations faced regular disruption from cartel violence and environmental protests. Peru contributed 130 million ounces, but political instability made long-term planning impossible. The supply-side constraints were becoming critical exactly as demand acceleration created unprecedented pressure on physical markets. Exchange-traded funds tracking precious metals had experienced $47 billion in inflows during January 2026 alone. But unlike equity ETFs that could create shares indefinitely, precious metals funds required actual bullion purchases to back new shares. The funds were competing with central banks, industrial users, and individual investors for a finite amount of physical metal that took years to discover, permit, and extract. The supply-side constraints were becoming critical exactly as demand acceleration created unprecedented pressure on physical markets. Exchange-traded funds tracking precious metals had experienced $47 billion in inflows during January 2026 alone. But unlike equity ETFs that could create shares indefinitely, precious metals funds required actual bullion purchases to back new shares. The funds were competing with central banks, industrial users, and individual investors for a finite amount of physical metal that took years to discover, permit, and extract. Investment advisors were recommending precious metals allocations to clients who had never previously considered commodity exposure. The traditional portfolio construction models that allocated 60% to stocks and 40% to bonds were proving inadequate for an environment where both asset classes faced systematic political and monetary risks. Financial planners were suggesting 10 to 20% allocations to precious metals as insurance against scenarios that had been considered impossible just months earlier. Pension funds were beginning to acknowledge that their long-term liability structures required protection against monetary debasement. Public employee retirement systems faced obligations extending decades into the future. If monetary authorities were willing to weaponize currency systems for geopolitical advantage, then pension funds needed portfolio protection that functioned independently of political relationships. The cryptocurrency markets were experiencing massive capital inflows as investors sought monetary alternatives, but even digital assets discovered physical constraints. Bitcoin mining operations required enormous amounts of electricity and specialized hardware containing significant silver for electrical contacts and circuit boards. As crypto adoption accelerated, silver content of global computing infrastructure was becoming a limiting factor. The irony was unmistakable. Digital currencies, promoted as alternatives to physical money, required increasing amounts of physical silver to function. Each Bitcoin mining rig contained approximately 0.5 ounces of silver in its circuitry. Ethereum mining operations use similar amounts. With global cryptocurrency mining consuming 150 terawatt-hours of electricity annually, the silver content of mining hardware represented another 25 million ounces of annual demand that most analysts had overlooked. Central bank digital currencies entering testing phases revealed additional silver requirements. CBDC systems required vast server farms and telecommunications infrastructure containing silver-based components. The digitization of monetary systems was paradoxically increasing demand for physical silver, just as traditional monetary metals gained acceptance as alternatives to digital currencies. International trade finance was adapting to post-dollar realities through mechanisms that increased precious metals utility. Letters of credit increasingly specified payment in commodity-backed currencies. Trade settlements were being structured around physical delivery rather than financial transactions. Multiple industries were incorporating silver stockpiling into operational planning. Defense contractors required silver for military electronics that functioned reliably under extreme conditions. Energy companies discovered precious metals offered hedging opportunities against political interference in commodity markets. Agricultural producers converted crop proceeds into precious metals rather than currency deposits that could be frozen by monetary authorities. Banking relationships were becoming increasingly difficult for businesses operating across political boundaries. Traditional business banking required political compliance verification extending beyond legal requirements. Companies were establishing precious metals treasury functions to maintain operational liquidity that couldn't be disrupted by banking political policies. The insurance industry was struggling to price political risk coverage for businesses operating across fragmented trade relationships. Lloyd's of London had withdrawn coverage for companies with significant exposure to dollar-dependent transactions pending comprehensive risk assessment. Business insurance was becoming impossible to obtain for enterprises that couldn't demonstrate independence from politically vulnerable financial systems. Real estate markets were experiencing capital flight as investors sought portable wealth alternatives that couldn't be confiscated through property taxation. Precious metals offered wealth storage independent of geographic jurisdictions while remaining globally acceptable. Property investors were diversifying into portable alternatives, providing protection against political developments in specific countries. The technology sector was confronting supply chain vulnerabilities that threatened digital infrastructure. Silver shortages could disrupt semiconductor production, telecommunications manufacturing, and renewable energy deployment. Tech companies were stockpiling silver as strategic inventory rather than just-in-time procurement. Healthcare systems were preparing for supply chain disruptions affecting medical device availability. Silver's antimicrobial properties made it essential for medical applications that couldn't be substituted. Hospitals were establishing silver stockpiles as operational insurance against supply failures. As January 23rd concluded with gold holding above $2,500 and silver approaching $130 per ounce, the precious metals markets were reflecting fundamental changes in how global commerce, finance, and monetary policy functioned. The rally wasn't speculative enthusiasm or technical momentum. It was systematic recognition that the institutional frameworks that had governed international economic relationships for decades were proving inadequate for an era of geopolitical competition and monetary weaponization. The question facing investors, businesses, and governments wasn't whether precious metals would continue gaining value. The question was whether the international economic system would stabilize around new monetary arrangements that included precious metals or continue fragmenting until alternative systems emerged to replace dollar-based infrastructure entirely. Smart money was betting that the gold record and silver surge marked the beginning of a precious metals supercycle that would last years rather than months. The structural forces driving demand were accelerating rather than moderating, while supply constraints were becoming more severe as geopolitical tensions complicated mining operations and trade relationships. Academic economists were modeling scenarios where precious metals played increasing roles in international monetary architecture. The Bretton Woods system had collapsed when political pressures exceeded institutional capacity. The current dollar-based system was experiencing similar stress as monetary weaponization became routine policy. Historical analysis suggested that monetary systems collapsed gradually and then suddenly, with precious metals providing continuity during transitional periods. Financial advisors were updating client portfolio recommendations to reflect new realities where traditional asset allocation models no longer provided adequate protection against systematic political interference in financial markets. The standard recommendation of 5% precious metals allocation was being revised upward to 15-25% as insurance against scenarios that had been considered impossible just months earlier. High net worth individuals were converting significant portions of their liquid wealth into physical precious metals stored in private vaults located in politically neutral jurisdictions. Switzerland's precious metals storage industry was experiencing unprecedented demand growth. Singapore had become a regional hub for Asian precious metals storage. Even Dubai was positioning itself as a precious metals custody center. The precious metals explosion of January 2026 was revealing itself as the visible symbol of invisible structural changes that were reshaping global economic architecture. And increasingly, the evidence suggested that those changes were irreversible.